Welcome to Sharpe Insights, Conversations with Your Plan Giving Experts, a podcast for development professionals. Whether you're new to the field or looking to enhance your existing program, we will provide practical tips, expert advice, and real-world stories to deepen your understanding of plan giving. If you're committed to securing long-term support for your nonprofit, you've come to the right place.
Welcome to Sharpe Insights, Conversations with Your Plan Giving Experts. I'm your host, Grant Miller. In the plan giving universe, tax policy can influence donor behaviors for both good and evil, or good and bad. The new OBBBA changes that went into effect January 1st are opening up new opportunities and raising new questions for donors and the organizations they support. In this episode, we'll cover what development officers, advancement teams, and gift planners need to know, and how to steward your donors through this minefield with clarity and confidence. Returning to the show today is Chris Woehrle, an adjunct professor of taxation at Widger Law School, Villanova University, and Sharpe Group's technical resource. Chris offers the combined perspective of a lawyer, educator, donor, and a seasoned development professional. We're also joined by Barlow Mann, Sharpe's general counsel and resident plan giving Yoda, with decades of experience helping nonprofits secure significant major and planned gifts. Chris and Barlow, thanks so much for being here again.
Great to be here.
Chris, let's start with you. What is OB3, as some in Washington are quaintly calling it? What changed on January 1st that makes this more than just a long-term planning issue, and why should nonprofit leaders and donors pay attention to it right now?
Well, I think there are two. The first is we have as much permanence as human nature allows. Really, since the 2001 tax legislation, we've had the tax rate reductions and other valuable provisions being held under a guillotine of expiration. And now there are no expiration dates on the most valuable parts of the bill. So to the extent we can have some certainty in planning, I think we're there. So that's the good news. The more sort of storm cloud on the horizon, and this is just my point of view, is one of the things in the code that to me merits more attention going forward is a floor that has to be exceeded for charitable contributions to be deductible. Now, the floor that they have now, and we'll talk in a little detail later, it's very small, and I don't think it's going to be impactful. But all bad policy decisions have to start somewhere, and sometimes they can morph into larger problems. There's nothing stopping a future Congress from raising that floor. The other provision in there is a limitation on itemized deduction. The cap or reduction is, again, modest. It's only about 5%. But again, there's nothing stopping a future Congress from expanding or making more itemized deductions subject to the cap. And I say this against a background in which the interest expense on our debt as a percentage of revenues is getting closer to the real danger territory that we really haven't seen an advanced capitalistic economy weather. And probably it's safer if we never have to figure it out whether we could weather it. But for now, I think things are going to be good. They're going to be good.
Good. We always appreciate that positivity. I do kind of want to dig in more about this idea of floors and ceilings and the ways that they're changing. In simple terms, what does that mean for charitable deductions, and who's going to benefit the most from these changes, and who might not see much of a difference?
Well, I'll attempt that, and I'll let Barlow please comment. So the general idea of a floor is a charitable contribution or a medical expense deduction, which has its own floor. It's only the excess over the applicable floor that is eligible for a deduction if you're an itemizer. Now, in the case of charity, it's 0.5% of adjusted gross income. That's a very small, easy floor to clear. Medical expense it's much higher. It's 7.5%. And I think the Congress felt, certainly with the medical expense, they only want extraordinary medical expenses to be deductible. In the case of the much lower AGI floor, they're really trying to encourage people to give. So the amount that the deduction is nicked or reduced is still going to be very modest. Barlow, how about
I would agree with you. My initial analysis was at the impact of that 0.5%, and you run that up through the income ranges, it's really relatively minor, or I thought that it was relatively minor. Really, the same thing is kind of true with the cap. It's a couple of percent that is being adjusted. However, recently I talked to a donor that upon retirement, he decided as a retirement gig, he'd start a new business. And he's been going through these provisions, and he was very upset about a floor and a cap impacting his charitable gifts. And he was adamant that he was probably going to reduce his giving. Now, that's one individual. So it's a subjective comment that I've
Sure. Well, I did a rough calculation. It's essentially $5,000 of charitable deduction lost per, if I did the math right, $1 million of AGI. Boy, I'll speak for myself. I don't think that's going to stop people from making giving. Now, the floor, I mean, not the floor, but the cap, which is basically you lose 2/37 of your deduction. You do the math, that's roughly 5.4%. Again, I'm not sure that is going to be that negative, because you can have a way of managing that, I think, a little bit better, because you just have more awareness of where your taxable income is, so you don't tip into the top 37% bracket.
In fact, that's where our conversation led. It was obvious this donor was a very generous person, but he was really upset by this change. So I suggested, well, what if there was a way you could simply bypass your income completely? It turns out he's turning 73 and he's going to be required to make minimum distributions. And so I suggested, why not make the maximum amount possible as gifts? And then if something happens to him, he could continue to make gifts with the remainder of his retirement funds. And in both cases, bypass income tax, and potentially, if he's ultra high net worth, bypass the estate tax too. And he seemed very interested. It's funny, he had heard of the IRA QCD, but he was not yet required to make minimum distribution, so he had not connected the dots.
Yeah, and what's interesting is there's a gap. You're eligible for actually to make QCDs at 70 and a half, not your required minimum distribution age. Now, whether that was legislative oversight or Congress deciding we still want QCDs, it exists. And if you're trying to minimize your exposure longer term to the RMDs, there's nothing stopping you from using the QCDs at 70 and a half.
And how many millions of people are going to be impacted by the IRMA adjustments going forward? And so perhaps the strategy would be very wise for those that have other sources of income and lots of money in their retirement plans to take advantage of that, to avoid some of the adjustments that are just now becoming apparent in the new OB3 law.
Yeah, to give sort of a bottom line answer to Grant's original question about what would be the impact of the floor and the curtailment of itemized deductions for the highest level givers, I don't think it's going to be impactful in a dramatic way, maybe modestly. We'll have to have statistics to see that. The one group of donors, though, we can, I think, categorically say their cost of giving is going to go down. That is the people who have not been itemizing their charitable deductions, and now they get what I like to call the universal deduction, universal, all-encompassing, as opposed to above or below the line, because I went back and checked when we had, I think it was a $300 universal deduction. It was technically an above-the-line deduction, because I went back and looked at the form, and now going forward, it's technically a below-the-line deduction. And rather than exhausting myself or listeners about which it is, I just think universal is more informative.
I would agree with you. And again, the people that will benefit Grant, only about, Before the Tax Cuts and Jobs Act, about 25 to 35% of people itemized in a given year. After the current rate structure was changed and the standard deduction was greatly increased, only between 9 and 11% were going to be itemizers in a given year. So very few people were itemizing, and that meant that about 90% of taxpayers did not receive any benefit for their charitable gifts. So the non-itemizer deduction potentially is benefiting the large group that were primarily formerly non-itemizers. But as we'll see, some of the changes are going to increase itemizers under OB3, the SALT deduction, things like that.
Yes.
Okay. And continuing on this thread of the universal charitable deduction, as I understand, there's been a significant change to the universal deduction for cash gifts. Is that true? And what does that look like? And how does it alter the conversation for donors who usually don't itemize?
Well, I think that one, you have to give cash, not appreciated securities. But again, we're talking small dollar amounts of $1,000 or twice that if you're married filing jointly. You have to give gifts to public charities, but donor advised funds were excluded. A donor advised fund is actually a public charity, despite what some people may believe. But I think the Congress's thinking there was, if we don't want it to go into a donor advised fund and just sit there. If we're going to allow these universal charitable deductions, I think then they just want to make sure it's being immediately expended for a charitable purpose. Barlow, how about you?
Well, yes, it's an incentive. I think the idea was to provide an additional incentive to the mass of taxpayers that enjoyed supporting charitable organizations, but simply they weren't able to buy into the idea that somehow that was included in their new larger standard deduction. So it does provide a slight incentive for giving. In terms of the actual tax savings, they give the maximum of cash to qualified charities. The amount of savings is whatever their tax bracket is times that $1,000. So it's not a major saving, but it's producing an incentive nonetheless for people who support charities.
And it'll be interesting to see how soon you'll see in marketing material something that might be a little chutzpah, but I personally wouldn't be offended by it. You know, if you've been giving $1,000 a year without any deduction, would you ask your donor to give like $1,130 to have the same after-tax cost of your
Chris, I like that. You're picking up on the affordability index of giving. Your affordability index just increased.
That's right. And I always say, whatever the affordability or lack thereof is, it's not an economically rational decision to give. You are, at least from a money perspective, you have less because the cost of giving is going to be greater than zero. But there are outstanding charities doing very good work, doing it very efficiently themselves. So the tax savings, that's not a winning appeal. But you see a lot of it still in some organizations' materials.
Interesting. Thank you. Barlow, earlier you briefly mentioned the SALT deduction. It's up to $40,000, and that's attracted a lot of attention since the bill came into law. Who does the SALT deduction impact the most, and how does this make itemizing appealing again for certain taxpayers?
Going back to the Tax Cuts and Jobs Act, which Chris referred to, that they were making many of those provisions permanent, with permanent meaning permanent until it's not. The SALT deduction was for state and local taxes, and they created a cap. The maximum amount that could be deducted for state and local taxes was $10,000. So many people that had high state and local taxes, much in excess of $10,000, were knocked off of the itemizer group. Many of those people live in large states, some of which they're high taxes: California, New York, Illinois.
Keep going. New Jersey, Connecticut.
A lot of states. So they still may not be able to deduct all of their state and local taxes, but quadrupling that deduction is enough to allow them to, in effect, become an itemizer on very high state and local taxes alone. Every time there's a tax bill and there are changes, I think Chris would probably agree there are winners and losers under the tax bill. Well, this takes millions of Americans that felt like they lost something and is restoring a good portion of what they lost.
And speaking of winning, I very much have followed tax history. Good God, I won't say how long, but The statistics are interesting about a married couple filing jointly. In 1980, their average tax rate, the taxes paid divided by their taxable income, was roughly 33%. At the turn of the 21st century, it's about 22%. Right now, 2025, about 13%. So the marginal rates themselves against the broad expanse of history are historically low. Some people don't want to believe that, but you can look it up for those who doubt it. So people have more affordability, I think, to give than they might want to believe. And the other thing that relates to really the marketing efforts about this bill and taxes, most people are always astonished when I tell them how much gross income they can have and legitimately pay 0% capital gains tax, because it's the sum of the last dollar at the exit point for the 12% bracket plus their applicable standard deduction, and that comes out to a little over $128,000. So when I read all these materials about giving away appreciated property and avoiding the capital gains tax, that's legally and technically true. But for, again, more moderate donors, they have workarounds for that. And if their real goal is supporting charity but improving their cash flow, maybe a life income arrangement, especially a gift annuity, can be very attractive for them.
I think ultimately a lot of the marketing may be providing the sizzle, but everyone's circumstances are different. And that's why most gift planners from the philanthropic side working for a charity or companies like ours would say, check with your personal advisors before making a major decision.
Absolutely. Absolutely. Speaking of major decisions, so Barlow, how would you approach someone who hasn't been getting much benefit from their annual giving because of they're giving relatively small compared to their income? How would bunching work to improve what we'll call the tax efficiency of their giving?
That's, again, the devil's in the details, and some of the provisions that we talked about earlier, the floor and caps that are impacting your better donors, your major gift donors. Sometimes they can work around that by bunching a gift, but your rank and file donors can do the same thing. If they don't typically itemize, they can bunch their deductions to a single charity. For example, if Cornell is having a capital campaign, they could make the gift a single gift. They make a pledge that's going to be payable over 5 to 8 years, and they maybe make an end of campaign gift, and it's backed up by a bequest. So if anything happens, the gift is good. By bunching a deduction, assuming they don't die during that period of time, or if they front load it, they benefit now. And it's a workaround in that the cap and floor, they're subject to it one time, and then after that they've got the carry forward to work with. Really the same thing on the high end too. I believe they have more flexibility. The more assets you have, the more flexibility you have in choosing the form your gift will take, even though it may be the people in the middle that would benefit by thinking of, say, some sort of split interest gift, a gift annuity, or a charitable remainder trust.
Yeah, I think that's very on the mark. How do you think the volatility in the equity markets overall? We're just as we record this, we're 3 weeks into a new calendar year for investing.
Well, that's fascinating. If I could predict which way the markets were going, I'd probably be doing something else nowadays. But the majority of people have entered the last, really since COVID, they've had the fear that there was going to be a permanent crash in the markets. And really, virtually every year, the market has recovered or in recent years reached new highs. Right now, the Dow is within a very close range of hitting 50,000 on the Dow. The S&P has been trading at record levels. So while I'm nervous about potential overvaluations, there's a lot in this new tax law that is causing the economy generally to do well. We have relatively low inflation, relatively low unemployment. In fact, the inflation numbers and unemployment numbers are in a range where traditionally economists would consider them to be kind of in the sweet spot.
Yeah. I also think that those who are maybe between upper capacity and the highest capacity, they sort of have their shock absorbers already tuned up, whether that means they have enough cash on hand or they've got ability to borrow without incurring tax cost, that sort of steady state for their giving.
And many people in the middle, a substantial part of their equity holdings are in a 401k or 403b or IRA, and they have the benefit of being able to affect a tax-free reinvestment in those plans. So they might shift some of the portion from equities into cash or cash equivalents, not so much for the return right now, but just to reduce the value fluctuations in the equity share from pulling their retirement funds down.
Yes.
Barlow, as you mentioned, the devil is indeed in the details, and I really appreciate you both for exploring the nuances and the nitty-gritty of this tax law change so eloquently. And, you both have a career, I think, of making these complicated topics accessible to, say, a broader group of people and not just your colleagues and such. So I just want to zoom out a little bit and just, when major tax legislation like this is introduced, what are some of the biggest hurdles that donors have to get over or misconceptions? And how can nonprofits communicate these hurdles and changes and misconceptions clearly, but also responsibly without overpromising benefits or giving advice that maybe they shouldn't?
There is always that danger. And in this particular legislation, instead of just passing some type of continuing resolution where they're going to extend and make permanent the Tax Cuts and Jobs Act rates, which would have been maybe a 3-page bill. How many pages were in this OBBA3 legislation? Close to 900 or 1,000 pages. And
it was
a lot of fine prints.
Yes, I remember being surprised how long the PDF was. I dare not print it, but I did want to see how many pages it was. I'd like to say it's probably not in many people's interest for the tax code to be simple and straightforward. Barlow, forgive me for repeating this story, but Milton Friedman, who was a longtime advocate of a single flat rate tax system, was asked why he thought it would never be enacted. And he said, because it's in no one's interest. The people on the tax writing committees of both parties, that's one thing there's bipartisanship on. They both are the top fundraisers for campaign contributions. And the standard operating procedure, in the words of the late Russell Long, who was the chairman of the Senate Finance Committee, he would say, don't tax you, don't tax me, tax that fellow behind the tree. So when any bill is being proposed, it's their taxes are being raised, not your taxes. So people are always maybe hopeful their ox isn't getting gored, and they're perfectly fine with someone else's. But if you had a single rate system with no or relatively few deductions, credits, or exclusion, there would be too much truth in advertising about the impact of a tax bill. If they raise the rate, everybody's rate goes up. Now, you could try to ameliorate that by expanding a deduction, something like a standard deduction. But that's too much truth in advertising. And someone maybe at the Sharpe Summit or elsewhere said, boy, you're very pessimistic. And I said, no, I'm cheerfully skeptical. To me, which is a difference. It's like, I'll still continue the search for the honest man, notwithstanding difficulty in finding them.
That said, this particular bill is, and the devil really isn't in the fine print, and there are many interactions of the new law that I don't think anyone knows exactly what they're going to do yet. The impact, there are going to be some unforeseen impacts. That said, though, there's a lot of targeted relief in this new bill, and depending on who you are, much of that targeted relief has been really targeted towards ordinary people, whether it's the non-itemizer universal deduction, or whether it's expanded child care credits, or whether it's the extra $6,000 deduction for seniors, or certain amounts of tax-free tips or overtime. But in all of those, there are phase-outs involved, and there are all kinds of hoops you have to jump through. And even though you may qualify for the senior deduction, you may not qualify for all of it. Or if your income is high enough, you may not qualify for any of it. So the blanket internet feed, it leads people to believe it's almost a $6,000 credit instead of a deduction.
Yeah.
And so you really have to go through the entire, file your return, make sure all the interacting parts are worked out to see what happens. And do you remember when they were talking about reducing the 1040 to a postcard?
Yes. What happened to that?
Well, I think you explained it was not in anyone's interest to change the current system.
No,
the K Street lobbyists would agree with you.
Yes. Well, I think they would. Maybe in our next afterlife we'll come back as K Street lobbyists, Barlow.
Well, as we approach the end of the conversation, I do want to zoom out just even a little bit further. Say that we were in an elevator together. We got in the elevator on the first floor. We're riding to the 10th floor. You have 10 floors to tell me what the real opportunity here is for donors and nonprofit organizations if these changes are approached thoughtfully. What's our big takeaway here?
I'll start. I think the takeaway is first, sell or lead with the good that your organization's doing and doing it in an efficient manner. The next is how little this bill is likely to change giving at the absolute highest levels. And for your reliable annual donors, I think they may feel they're capable of more. And for your long time but perhaps modest donors, they may even feel they can do a little bit more. I'm not seeing much commentary that the bill in the aggregate is a negative for charitable giving. I'm more, thinking a little bit farther ahead in the future. There are things in there like the floors and the cutbacks in any financial crisis that could come up. I could see those being tweaked to raise relatively larger amounts of money. But I'm more a Cassandra on those types of financial predictions. My wife asks me, what keeps me up at night? Is it all the strife in the world? Is it some type of economic dystopia occasioned by artificial intelligence? And it's actually not that. It's that the day is coming. Our leaders are going to have to make good policy choices, and they're going to have to communicate them in persuasive, thoughtful manner. And right now, I'm not seeing on both sides of the Congress and in both political parties, I'm not seeing a lot of serious thinkers trying to address how do we deal with this ever-expanding principle on the debt. That's going to have to be addressed. That which cannot continue forever won't. And right now, maybe the best we can hope for is at least the rate of growth of principal on the debt is going to be smaller than the rate of growth of our economy.
That's very insightful. I tend to agree with you on those points. From a less sophisticated analysis, the majority of people enjoy supporting one or more charities.
Yeah.
Those that don't, I don't think the tax bill is going to turn them into donors.
Yeah.
I think it's going to be interesting in the short term to look at the economic analysis. And I would say, as you look at 2% of GDP, which has been a pretty predictive indicator, you mentioned that previously in another format, I think we're going to be in that range.
Yeah, I do too. It's amazing to me sometimes how little the needle is moved. If you're a charity, you want to move the needle on the people who are capable of doing more. And so don't be fatalistic.
And some charities meet and exceed their goals every year, and some don't. And some charities are going to end up probably merging with similar charities. So it's a very difficult time for the nonprofit market. And the tax bill by itself is not going to be a big negative nor a big positive, but for the trouble we've had with the percentage of households that support charities has been declining slightly for decades. The universal deduction may help stem those numbers falling further and may provide a reason, enough of an incentive for people to reconsider their giving.
Yeah, and get connected more.
Yes.
I always am disappointed how organizations do not reach out to everyone who gives at a certain level. Their behavior, the charity's behavior would suggest they just sort of take the donors for granted, or they're on automatic pilot, or they're dismissive of their financial capability, even though they haven't really, quote, researched what their financial capability is. So I have a question for Grant. Grant, where were all these Star Wars references? Did I miss any of them? Or was it so sly and hidden that it just went over my head since I've never seen any of the trilogy?
Well, let me just leave you with this. I think that when I was listening to you both speak there towards the end, I did get a sense of a healthy optimism. And I believe it was Leia Organa in The Last Jedi who said, "Hope is like the sun. If you only believe in it when you see it, you'll never make it through the night.
Yes, well, that's faith is belief in things not seen, that's for sure. I thought at the end of this thing I was going to hear Barlow say, "I am your father," or something like that.
How about the force is strong in this one?
Good. Very good.
I think the force is strong in this one. Yeah. And, overall, we hope that today's conversation helps our listeners better understand some of these changes that have happened with the OB3. Thanks so much, Chris and Barlow, for joining us and for sharing your expertise.
Well, thank you.
Experience.
Thank you for the invitation.
Yeah. And I'm sure we'll have you back as we continue to unpack this and see the impact that it has in the plan giving world. And if you found today's episode helpful, please subscribe and share with colleagues in the field. Thank you for being a part of this conversation. And until next time, may the force be with you. Thanks for listening. We hope today's discussion gave you practical takeaways to grow your plan giving program. To submit questions and topics for future episodes, go to sharpegroup.org or listen to us on your favorite podcast app. If you found this podcast insightful, be sure to like, review, and subscribe. Until then, stay sharp.